So hello dear students, welcome to video 3 of our case scenario discussion, and now we'll be doing the next 5 cases, and today itself I'll try to upload the next video, part 4. Okay, so without wasting time we are moving on to case scenario number 13. PQR is engaged in providing a wide range of telecommunication services, including mobile connectivity, broadband, and enterprise network solutions. It prepares its financial statements in accordance with Ind AS and follows the financial year for the purpose of accounting and reporting. Okay, see, this case scenario covers Ind AS 115, 19, and 109. So, first one. The customer buys modem from PQR Limited. Okay, so PQR Limited is the entity. A customer buys modem from PQR Limited. However, customer can also get the connection from PQR and modem from any other vendor. The installation activity requires limited effort and the cost involved is almost insignificant. It has various plans where it provides broadband services or voice call services or both. So PQR Limited is giving modem. So they are trying to say modem can be bought from any other vendor. We'll sell connection separately. The customer can get broadband, voice call services or both. So let's read the corresponding MCQ right now. How many performance obligations are there? Broadband services, voice call services, modem, all of the above. Which one is the right answer? Because all these are not interconnected. How I'll identify how many performance obligations in a contract? If the performance obligations are distinct and they are given at standalone prices, it will be considered as a separate performance obligation. Yes. So what do you mean by distinct? Customer gets separate benefit and each benefit can be separately identified. No significant integration service, no significant customization and not highly interrelated. So broadband, voice call, modem, it's not highly interrelated. A customer can get only modem or customer can get modem and broadband or customer can get only broadband or only voice call. So how many performance obligations are there? What is the right answer? All of the above. Okay. Now, next one. PQR has 350 employees, same as a year ago. Okay. The average staff attrition rates observed during the past 10 years is 6% per annum. So, what I should understand is, last year there were 350 employees. Of that 350 employees, 6% would have left and 6% would have newly joined. PQR provides to all its employees paid vacation of 10 days per year regardless of the date of hiring. Okay. Compensation for paid vacation is 100% of employee salary. If you take vacation for 10 days, you will be getting 100% of salary. And unused vacation, okay, if you are unable to take this vacation in the current year, you can carry forward it and next year you can take 20 days. So a leave which can be carried forward to next year is short-term compensated absences, accumulating and non-vesting. Vesting means you can get the unused leaves, encashment. This can be carried forward, it is non-vesting. At 31st March 2011, unused vacation can be carried forward was 3 days per employee. Okay. And average salary is 15,000 per day. And accrued expense for unused vacation in 10-11 is 65 lakhs. So this is last year's. During 11-12, this is the current year, employees took 9 days of vacation in average. Salary increases in 11-12 was 10%. So what is to be done? So here what I am finding out is there are 350 employees today. So of which 350 employees, 6%. 21 employees will be new joinees and 350 minus 21, 329 employees are existing employees. 329 employees are existing employees. So here this unused leaves can be carried forward to next year. So how many unused leaves are there? So here I need to find out for existing employees Opening carry forward 3 days are there, which is not there for new employees. And current year entitlement 10 days. Regardless of the date of hiring, both set of employees will be getting 10 days. So total 13 days vacation is there for existing employees. 10 days is there for new employees. And how many days they have already taken? 9. So 4 days of existing employees and 1 day of new employees can be carried forward to next year. So 329 into 4, 1316, 21 into 1, 21. So 1316 plus 21. We need to create provision for 1337 days. We need to create provision. And what is the salary they are telling? Last year salary is 15,000 per day and salary increased by 10%. So 1337 into 16,500. 2,20,60,500 is the provision to be created. Okay. What would be the, so question number 2, what would be the unused vacation in terms of man days? We computed 1337 days. For 329 employees, 4 days. And for 21 employees, 1 day. So how much is the provision? We already calculated this 1337 into 16,500, 2,20,60,500. Now what would be the accounting treatment? So the next one we have not read. PQR Limited has taken 6-year term loan in April 2010 from bank and paid processing fees at the time of sanctioning of loan. Oh, you paid processing fees. The term loan is disbursed in different tranches from April 2010 to April 2016. Okay. So PQR Limited we have taken a 6-year loan in April 2010. The term loan is disbursed. So entire amount is not given on single date. The amount is disbursed in different tranches. On the date of transition to Ind AS, that is 1st April 2015. Oh, this is Ind AS 101. 101 and 109 financial instrument is there, 101. It has calculated the net present value of term loan disbursed up to 31st March 15 by using effective interest rate, and proportionate processing fees has been adjusted in disbursed amount while calculating net present value. Okay. So what is the question? What would be the accounting treatment of processing fee belonging to undisbursed term loan amount in case of future drawdown is probable? So what does that mean? So here, see what is to be done. Now listen here. If there is a loan of 10 lakhs and there is a transaction cost is 1 lakh, you have withdrawn only 5 lakhs. Say for example, only proportionate transaction cost should be deducted from 5 lakhs. The balance 50,000 should be deducted when the future withdrawal, future loan is received. I'll be adjusting. So when you are withdrawing the balance 5 lakhs, then 50,000 will be adjusted. So here, what would be the accounting treatment of processing fee belonging to undisbursed term loan? Which means if 5 lakhs is not withdrawn, what is the treatment of that processing fee belonging to undisbursed term loan? Future drawdown is probable, means in future you will be, it is likely to withdraw the amount. A loan is already sanctioned and you can withdraw the amount in future. Then what is the accounting treatment? What are the options given? The processing fees is accounted as transaction cost under Ind AS 109, but not deferred and deducted. No, it will be deferred and deducted from the carrying value of financial liabilities. Option B, the processing fees is accounting for as transaction cost under Ind AS 109 and the fees is deferred and deducted from the carrying value. Yes, when the drawdown occurs. Then The processing fees is recognized as expense. No. See, processing fees will be recognized as expense if future drawdown is not probable. If you are not able to withdraw the balance amount, then processing fees will be recognized as expense. Then processing fees is not accounted as transaction cost. Wrong. So option B is the right answer. Did you get that? Now, what would be the accounting treatment of processing fees belonging to undisbursed loan? In case future drawdown is not probable, if you are not able to withdraw, then that transaction cost relating to this undisbursed loan. So the transaction cost relating to this undisbursed term loan will be recognized as expense. So same options are given. The processing fees is not accounted as transaction cost because there is no liability against which it can be adjusted. It will be recognized as expense on straight line basis over the term of loan. So option C is the correct answer. So all the above 1337 days, 2 crore 20 lakh 6500. Option B, it will be accounted as transaction cost. Fees is deferred and deducted. But future drawdown, future withdrawal is not possible. It cannot be accounted as a transaction cost. So it will be recognized as expense. Okay. So now let's move on to case scenario number 14. Case scenario number 14 is a Paka illustration from Ind AS 103 business combination. Please have a look. ABC Limited prepares consolidated financial statements up to 31st March each year. On 1st July, ABC acquired 75% of equity shares of JKL Limited and gained control. Correct. The issued shares of JKL Limited is 120 lakhs equity shares. So you should understand 120 lakhs into 75%. 90 lakh shares are acquired by ABC Limited. Okay. On 1st July, ABC issued 2 shares for every 3 shares acquired. And on 1st July, the market value of equity shares of ABC is 6.5 and market value of equity shares of JKL is 6. Why do I need the market value of equity shares of JKL? Acquiree's fair value on the date of acquisition is needed either to measure NCI or if there is step acquisition for previously held interest to measure the previously held interest. Anyway, let's find out. So here ABC issued 2 shares for 3 shares held. So 90 into 2 by 3, 60 into 6.5, 390 lakhs will be given as purchase consideration. On 30th June 2012, that is 1 year later, ABC will make a cash payment of 71,50,000 to former shareholders who sold their shares to ABC on 1st July. On 1st July, ABC would have to pay interest at an annual interest rate of 10% on borrowings. What is this? Will make a cash payment means deferred consideration. No conditions are given. Deferred consideration. So 71,50,000 you will pay after 1 year. So divided by 1.10, taking the present value, it comes to 65 lakhs. Then on 30th June 2013, 2 years later, ABC may make a cash payment of 3 crores to the former shareholders of JKL who sold their shares to ABC on 1st July. The payment is contingent upon the revenue of ABC growing by 15% over 2-year period. On 1st July, the fair value of contingent consideration is 2 crore 50 lakhs, 250 lakhs. And 31st March 12, the fair value has become 220 lakhs. Contingent consideration should be considered as purchase consideration and should be taken at what value? Fair value on the date of acquisition. Then subsequently the fair value changed, that we will consider later. On 31st March, the difference in contingent consideration will be taken to P&L. So let's wait. On 1st July, the carrying value of net identifiable assets, carrying value is 6 crores and fair value is 7 crores. Deferred tax rate on temporary difference is 20 lakhs. So here old carrying value is 6 crores and new fair value is 7 crores, which means the assets are taken over at a profit. When assets are taken over at a profit, is it deferred tax asset or deferred tax liability? Deferred tax liability. If assets are taking over at a profit, there will be a deferred tax liability. So 1 crore into 20 percentage, 20 lakhs deferred tax liability. So 7 crores minus 20 lakhs, 680 will be the fair value of net identifiable assets taken over. Along with 7 crores, a 20 lakhs DTL also should be taken over. So it is 80 lakhs will be the fair value of net identifiable assets. During the 9 months ended on 31st March year ending date, JKL had a poorer than expected operating performance. Therefore, on 31st March 12, it was necessary for ABC to recognize an impairment of goodwill, which is amounting to 10% of computed value. Okay, let's find out goodwill first. So, of that total goodwill, 10% is impairment loss. So, what are the questions here? What would be the amount of net assets on the acquisition date? We calculated 680 lakhs, 7 crore minus deferred tax liability 20 lakhs. What will be the amount of goodwill in case NCA is measured at fair value? So purchase consideration we calculate as, take the total 390 plus 65 plus 250, 705 lakhs is purchase consideration. NCI is, if it is fair value, 120 lakhs into 25%, 30 lakhs is outside shares into what is the fair value per equity share of JKL? 6 rupees. So NCI is coming to 180 lakhs. So 885 lakhs compared with net identifiable assets 680. So 885 minus 680, goodwill comes to option A, 205 lakhs. Goodwill is 205 lakhs. Okay. What will be the amount of goodwill in case NCA is measured at proportionate share of net assets? If proportionate share of net assets, purchase consideration is 705. NCI comes to 680 into 25%. 170. So 875. Net identifiable assets is 680. So 195. Option B. So 680 lakhs, 205 and 195. But impairment is 10% of this, but that is not asked. I think that is okay, right? Case scenario number 15. On 1st April 2011, S Limited issued 30,000 6% convertible debentures of ₹100 each. The debentures are redeemable at a premium of 10% on 31st March 15. So 11, 12, 13, 14, 15, 4 years. Or these may be converted into ordinary shares at the option of the holder. The interest rate for equivalent debentures without conversion rights would have been 10%. So here 10% is the actual interest rate for a non-convertible debenture. Because it is convertible, it is 6%. Date of transition is 1st April 2013. 3.17 is the present value factor of annuity. Then on maturity, 110 will be paid. Okay. Analyze the transactions mentioned above and choose the most appropriate option in the below question 1 and 2 in line with relevant Ind AS. Okay. Only 2 questions are there. What would be the accounting treatment of 6% debentures on the date of transition? So, what is the date of transition? 1st April 2013 is the date of transition. So, as per Ind AS 101, first time adoption of Ind AS, on the date of transition, liability is still outstanding. Yes or no? On the date of transition, the liability is not paid, not settled. It is still outstanding. So, on the date of transition, as usual, split the debentures into equity and liability. Liability will be unwinded and settled on this date. So what would be the accounting treatment of 6% debentures on the date of transition? Since the liability is outstanding on the date of transition, S Limited will need to split the debentures into debt and equity portion. Okay. Since the liability is outstanding, S Limited need not split. Wrong. The entire amount will be recognized as equity. Wrong. The outstanding will be considered as repay. No. So option A is the correct answer. What would be the amount of financial liability to be recognized on the transition date? Very good question. So here what we should do, carrying value, first we need to calculate on retrospectively, that is on 1st April. What would be the carrying value of loan? Interest. 30 lakhs into 6%, 1,80,000. Sorry. So interest is 1,80,000 into annuity factor 3.17. And principal repayment is 30 lakhs plus 10% premium, 33 lakhs. And 33 lakhs into 0.68. Only 2 decimals they have taken. So 2 decimals. So 1,80,000 into 0.68. 22 lakh 44. 22 lakh 44. So it is coming to 28 lakh 14,600 is the value of debentures at the beginning. So on 1st April 2000, what is the date? 2011. So then we prepare the amortization table. Year 1, 2, 3 and 4. So 28 lakh 14,600 will unwind interest 2,81,460. Repay 1,80,000. 29 lakh 16,060. So this is 1st April 2011. So this is 31st March 2012. 1st April 2012. What is the balance on the date of transition? That is 1st April 2013. So 29 lakh 16,060. 2,91,606. 1,80,000. Minus 1. 30 lakh 27,666. So 1st April 2013 transition date. 1st April 2013, what is the value? 30 lakh 27,666, option B. So first you calculate the value as on that date, original value, what would be the value, then unwind as usual, find out what is the value to be accounted on this date. Did you understand? Hope so. Case scenario number 16. Z Limited is engaged in manufacturing of automobiles with its registered office in Pune and is listed on Bombay Stock Exchange. It also owns a chain of retail stores across 20 different locations in the twin cities of Pune and Kolhapur. Following are the brief facts about the transactions entered into by the company for which accounting advice is sought by CFO of Z Limited from you. Z Limited owns 2 vehicles on 1st July. So let's be careful. Z Limited owns 2 vehicles on 1st July and a local statute was passed which necessitated Z Limited to undertake modifications to the vehicles to enable reduction of harmful emissions. The modification should have been completed by 31st December 2011 at an estimated cost to Z Limited of 20 lakhs. Okay. Actually, by 31st March, none of the vehicles had been modified, although they are continued to be used. So wrong. So you should have done this modification by 31st December. And that is a statute, that's a rule. But 31st March, you have not done any modification. It is quite likely that Z Limited will have to pay a penalty of 2 lakhs per month for this illegal usage of vehicles. The directors of Z Limited intend to carry out modification only at the end of March 13 due to paucity of funds. Oh, They expect the penalty will become payable very shortly as legal action has been initiated against Z Limited. So, you need to create provision. There is present obligation arising out of past events and the outflow of resources embodying economic benefits are more probable, more likely. Therefore, provision should be created. How much provision to be created? 2 lakhs per month means 3 months. 2 lakhs into 3. 6 lakhs provision is to be created. Correct. Now on 1st April, Z Limited has issued 1 lakh loans of rupees 5 at par. 1 lakh loan notes of rupees 5 each. The loan notes entitle the holder for an interest payment of 8% per annum payable in arrears. Okay. The loan notes are repayable at par on 31st March 15. So 11, 12, 13, 14, 15, 4 years. As an alternative to repayment, the holder can elect to convert the notes into equity shares. On 1st April, the investors in non-convertible notes is 10%. So you are given discounting rates. And on 1st April, Z Limited has 2 equity investments. So that's a different question, I think. Okay. Okay. Or shall we read the questions on these 2 areas? Okay. Then we'll read this. Okay. What will be the amount of provision? Provision is 3 months into 2 lakhs, 6 lakhs. Very basic question. Calculate the amount which should have been in which should have shown in other comprehensive income for equity. So that I think that is related to the next case. What will be the finance cost of convertible loan notes issued by Z Limited for the period ending 31st March 12? So initially the loan will be recorded at initially. So 1 lakh into 5 lakhs into 8%. 40,000 into 4 years means 3.17 discounted at market rate. Then year ending 5 lakhs into 68.3 paise means 0.683. So it is coming to 4,68,300. So what will be the finance cost for the year ending? Is 46,830. Option C. Option C, 46,830. Now, on 1st April, okay, now let's read the next one. On 1st April 2011, Z Limited has 2 equity investments that is designated as FVTOCI, Shell, okay. K Limited original cost 30,000, fair value 37,500, fair value not applicable. Maybe we would have solved it. 27,500, 35,000, 38,500. On 28th February 2012, Z Limited disposed of the investments for 50,000 and shown a profit on sale as part of investment income. Apart from recording the receipt of dividend income, no other entries have been made in the financial statements regarding the investments in H Limited. Both investments have been correctly treated in the financial statements. So calculate the amount which should be shown in OCI for the period 31st March on account of equity investment. So during this 31st March 12, there is a gain of 38,500 minus 35,000. 3,500 gain will be there. And also this is sold for 50,000. So 50,000 minus 37,500, 12,500. Total gain of 16,000 would have dropped in OCI for the current year. So for the year ending 3,500 and 12,500, 16,000. This 12,500 will be later reclassified to retained earnings. But for the period, how much amount will be fallen to OCI? 16,000. Okay. Now, case scenario number 17. C Limited is preparing financial statements for the year 31st March 14. Okay. The board is scheduled to approve the financial statements on 30th May 2014. On 1st April 13, that is the beginning of the financial year, C Limited issued 1 lakh rupees 10 bonds for 10 lakhs. Okay. On 1st April, each year interest at the fixed rate of 8% per year is payable on the outstanding capital amount of the bonds. That is, first payment will be made on 1st April 2014. Okay, got it. So 1st April, I'm taking a loan of 10 lakhs and interest of 8% is payable at the beginning of next year. The first payment will be made on 1st April 14. Understood. On 1st April each year, that is from 1st April 14, C Limited has the contractual obligation to redeem 10,000 of this bonds at 10 per bond in its balance sheet at 31st March 14. How should this be presented in the financial statements? So normally we find out the fair value of the loan, but here market rate is not given. So actual rate is the market rate, let's assume. So loan amount will be 10 lakhs only. There is a total loan of 10 lakhs and 80,000 interest payable. That is interest payable not at the end of the year, beginning of the next year. And also it is given that 10,000 of the bonds at 10 is repayable, redeemable 1st April each year. So 10 lakhs loan plus 80,000 is the total interest payable. This 80,000 interest and 1 lakh of the total, out of total 10 lakhs will be presented as current liability. And balance 9 lakh payable after 12 months will be presented as non-current liability. So how this will be presented in the financial statement means 1,80,000 current liability and 9 lakhs non-current liability. That is how it will be presented in the balance sheet. Let's find out the question. But before that, C Limited sells a piece of machinery to the customer for 2 million. Okay. Payable in 90 days. We sold a machine for 2 million payable in 90 days. C Limited is aware at contract inception that the customer might not pay the full contract price. C Limited estimates that the customer will pay at least 1.75 million, which is sufficient to cover C Limited's cost of sales, 1.5 million, and which C Limited is willing to accept because it wants to grow its presence in the market. C Limited has granted similar price concessions in comparable contracts. C Limited concludes that it is highly probable that it will collect 1.75 million and such amount is not constrained under variable consideration guidance. Okay, so contract price is 2 million, but you are expecting to collect 1.75 million. So what is the standard? Ind AS 115, revenue from contracts with customer. What is the transaction price? Transaction price is the consideration the entity reasonably expects to collect. If substantial amount of the consideration is collectible, it is fine. If the customer has the ability and intention to pay 1.75 million, 1.75 million will be taken as the transaction price. Again, let's find out the question. Now, on 15th April, company discovers a significant fraud that actually occurred during 11-12. Okay, 11-12, 12-13, 13-14 now. The fraud involved overstatement of revenue by manipulating sales invoices during those earlier years. So we discovered a fraud now that we have already committed in 11-12 and there is overstatement of revenue by manipulating sales invoices during those earlier years. That mistake was committed those years, but we discovered only now, right now. So what is the treatment? So let's find out what the question is. Now, C Limited has recognized goodwill worth 80 lakhs in the past for a business combination. Okay. During the current year, it has impaired goodwill by 16 lakhs, carrying amount is 64 lakhs. Amortization of impairment of goodwill is not deductible as per tax regulations applicable in this jurisdiction, where C Limited files tax returns. Applicable tax rate is 30%. See, for goodwill, there is no deferred tax. So, as per Ind AS 12, deferred tax shall not be recognized. There are two exceptions given. The initial recognition of assets and liabilities, except that arising out of business combination, and goodwill that arising out of business combination. So if goodwill is arising out of business combination, no deferred tax impact is there. So we don't know why that is given. Let's find out the questions. State which of the following statement is correct with respect to bonds issued. 80,000 accrued interest and 1 lakh current portion of non-current bond would be presented as current liabilities. Correct. Option A is correct. B. Entire 10 lakhs will be presented as non-current liability. Wrong. Entire 10 lakh would be presented as current liability. Wrong. 80,000 accrued interest and 1 lakh current portion of non-current bond would be presented as non-current. Wrong. So option A. What is the transaction price in the arrangement to sell a piece of machinery to the customer? 1.75 million. We were already saying 2 million, but you are expecting to collect only 1.75 million, then 1.75 million. State which of the following statement is correct with respect to fraud related to 11-12. Discovered at the end of reporting period, but before the date of approval. The discovery of fraud is a non-adjusting event. Wrong. It's an adjusting event, because it provides additional evidence for the conditions already existing, because sales invoices were already overstated. So discovery of fraud is an adjusting event as the fraud took place before the end of the reporting period, which is confirmed after the reporting period but before the approval. So this retrospective restatement, this is the correct. The discovery of fraud is an adjusting event as the fraud took place before the end of the reporting period, which is confirmed after the reporting period but before the approval of financial. Hence it is to be adjusted 13-14 without retrospective restatement. No, with the retrospective restatement. Non-adjusting event. Wrong. What is the amount of deferred tax? No deferred tax asset or liability will be created. First one, second one, third one, retrospective restatement. Okay, very good. So that's it guys. Let's meet in the next video.